Hello, everyone. Welcome back after the break. I'm Jake Rigby. I'm continuing to chair stage one as we go through the rest of the day here today. It gives me great pleasure to introduce our next speaker, who is Graham Gow. He is Associate Director at BVG Associates and is going to be talking today about investing in offshore wind. Graham, over to you.
Thanks, Jake. So Graham Gow, Associate Director at BVG Associates, and I wanted to use my session to take a little bit of a step to the side from all the very detailed engineering and technical discussions that we get on this platform, and talk about the money side and how people with innovation and products to sell get that either invested in or taken up by the market. So it's only 20 minutes. I can only touch on so much, but hopefully just a sort of different angle at the whole problem or the whole challenge of innovation in our industry. There we go. So for those who do not know anything about BVG Associates, we're a global consultancy, although fairly small. We're located in the UK, but we have global reach, and we consider ourselves a sort of business strategy consultancy in the renewable space. It's renewables, but it's mostly wind, and it's mostly offshore wind. We work in about 3 different areas that we categorize on screen here. And the third one is my area, the sort of business strategy area, where we look at market and technology, supply chains, do quite a lot of work in the O&M space and market intelligence. And it's the experience that we've had in that space that informs these slides. So I'm going to talk about 3 things. We're going to talk about money and investors. It's not just investors, but basically where money comes from and what money cares about. We're going to talk a little bit about engaging with developers or owner-operators in order to actually get your products to market. And I hope what comes out of this is getting people in the supply chain to think a little bit more about what the money side and the buying side care about when you are trying to engage with them and trying to sell your products to them. I've decided to start with the last thing first, which is the kind of key takeaways. So at least you get that, and then some of the following slides will kind of fall into place a little bit. For investors and the money side, it is all about the money. It is all about, if somebody's seeking to invest in your firm or your product, they need to understand what the future growth and future income looks like. And to do that, they have to understand your competitors, your place in the supply chain, where and how you add value, impact on things like the bottom line. So that's the financial impact, often done as a kind of LCOE analysis, but there are other ways of looking at the bottom line. And we need an understanding of how the market evolves, not just in size and scope, but in the nature of delivering the thing that your service line, your product. So if you take rope access on blade inspections, for instance, just because you have a really good rope access blade inspection unit now and have for the last few years doesn't mean that that's going to be valuable in the future, because as you've just seen from the last speaker, there's more and more automation coming in. So things like things like that. That's what buyers and people with money concentrate on, what this looks like moving forward. For developers, and specifically developers rather than owner-operators, it's usually all about the risk. It's usually about how bringing your technology in affects the risk profile of the project. You also need to understand the different types of, if we focus on developers, the different types of developer or the different types of owner-operator and how they manage innovation and third-party solutions. So we'll touch a little bit on that, about engagement types and engagement processes. And if your product is in the kind of early stage development, early TRL, and you're seeking support and investment from like national funding bodies and support frameworks, then for them, it's really all about the politics. It's all about how your product and offering can benefit the wider industry, such as greater local content, greater speed of delivery, simplicity of maintenance, and having good engagement at that early TRL stage also helps de-risk and answer some of the questions that investors and buyers ultimately have. So we'll talk about the money side. We'll start with investors. There are different types of investment capital. So there's venture capital, growth equity capital. Sometimes we get involved in kind of leveraged buyouts and distressed assets, but it's really venture capital and growth equity that's of relevance in this space in terms of investing in your company and your product. We also come across money when we as BVG Associates, but it does impact how your future might look as a supply chain company when there's mergers and acquisitions. So when somebody's buying another company, they go through all this exactly the same sort of market evaluation process that we're about to talk about. And the money can also come from large companies where you are a small part, possibly a parent company, but when the larger part of the corporation is undertaking a business strategy exercise and trying to understand where its own money should be focused. And on the blue box there is just some kind of relevant stats about why I'm here at all talking to you about this and our involvement corporately in this space over the years. I guess the last point's the sort of main one for me. We've done about 40 privately engaged kind of business strategy consultant exercises over the last 3 years. So a market analysis always starts with a capacity for wind. It's all about the growth of a particular market space, which quickly then turns into an estimation of value based on what you're offering. As I said, you need to understand, coming into that is an understanding of future trends and a competitor analysis. And those three things are underpinned by a number of different tools and frameworks that we use, and anybody else doing the same sort of work will use. There are dozens of sort of tools and frameworks that can be used. These are the ones we tend to use, and they tend to be focused on whether you're evaluating a market, whether you're evaluating a company, and so on. So if you're in this space, seeking investment, seeking buyers, it's good to kind of familiarize yourself with these tools and frameworks because the people that you are trying to attract will be using them. You don't need to read the writing on this. It's more illustrative. One of the very high-level approaches that investors will do is try and map out the space of a particular bit of the market. It can be called a competitor matrix. There are other ways of looking at it. But the key thing is, what this matrix shows is all the service lines, at least all the service lines that are of interest, that define that market space. This happens to be operations and maintenance in offshore wind. And all the suppliers that are of relevance in that space as rows. And then what you do is you start filling in the matrix about who does what. And what that gives you is a sense of scale of service offering for each of the suppliers, and crucially, it gives you a sense of competition in each of the service line areas. And so if you're a venture capitalist, what you're looking for is kind of niche technical offerings where there's very limited competition. In that case, it happens coincidentally to be unmanned aerial drones for external monitoring purposes, but that was just taken at random, and that shows you two companies that have niche offerings in a very limited competitive space. So those types of companies would be very interesting to venture capitalists. You can use the same matrix to sort of look at growth equity interests, where somebody's limited by either the current offering or by the current market that they're able to reach. And I won't go into the details, but those would be two competing companies with very similar service offerings, but which differ a little bit, and one's restricted to the European market, one has global market. And so growth equity funds would go in and see what they could do with the slightly more limited one in terms of expanding the service lines or expanding the market space. But nothing in any of this progresses without a detailed understanding of the value that you have in this space. And like I said, it all starts with the capacity forecast. And there are different ways of doing capacity forecasts and different ways of splitting it up depending on what it is you need to do. You can do a top-down capacity forecast. That happens to be the one on the left, the multicolored one. That's a top-down global view of offshore divided into different markets. And by top-down, we mean taking country-level ambitions effectively at face value. So if somebody says, oh, we're going to have 40 gigawatts by 2030, that's considered a forecast. And people will do kind of nuanced understanding of that and build up a picture top down. The other one is just UK scope, and that's done bottom up, where we take all the known projects in whatever state they are that's in the pipeline for the UK, and we effectively push them forward in time to try and understand what the market's going to look like. And it's really important when people do capacity forecasts to understand the difference between those two things, because you could do a top-down and a bottom-up for the same market space and get very, very different numbers. So, yeah, it's just one of the key things that people try and look at and understand as part of this process. So underlying that, there is an assumed project life cycle set of milestones as they go through development phases, through construction and into operation. And what we do is we marry that underlying timeline of development with a detailed understanding of the costs. We're not going to look at the costs in any detail, but the key thing is that a really good cost model for the industry allows you, as a product or service offering to say, here is exactly where our product offering sits, and here is how much it's worth in this big picture of costs. And so what then happens is you take all this information, and what we have on screen now is a sort of very condensed version of one of those tools, one of those market assessment tools called a TAM, SAM, SOM, where the graph on the left is like the total global market value for this particular offering that was highlighted. So no constraints, just in the world, this is what the value of this service looks like. And then the one on the right is a much more reduced one, which takes into account where you can deliver your service, when you can deliver your service, what level of competition you've got, and then creates a much more realistic view of what your particular service offering or product is likely to face. And like I said, like this sort of analysis can cost many thousands of pounds and take many weeks. So this is a very sort of condensed idea of what's involved, but hopefully by sort of telling you this, it gives you ideas that you need to, if you are trying to engage with investors or buyers, whether it's an M&A or just trying to convince your corporate parent, these are the things that they will be looking at. So the more you look at it, the more aligned that and positive that engagement should be. So we'll then talk about, well, we're now going to talk about engagement with projects, because that's another crucial part of trying to get things to market, is trying to have a place to put them, somebody willing to buy them at all. Again, there's a lot to say in this space. I've just taken a couple of examples to show you the type of thing that we do when we're advising people in this space. We usually categorize the potential buyers into types. And I've done this. These are the three categories that we often use for the operations space. And it's usually down to how they deal with innovation. Some have no internal departments for innovation, and it's all third-party solutions that they buy in. Some are halfway house, and some have a very heavy internal development team with very little use of third-party solutions. And how you deal with these different types is significantly different between them if you're trying to sell your product to them. And so this is just a very little functional map of just one of those three types. And it shows, it starts to describe who in the department, who in the corporation is likely, what role is likely to be the one that you need to talk to. In this case, it's head of asset management. And the head of asset management is the one that will manage communications with site and manage communications with the wider corporate needs, such as IT and legal. And they are the role that will take you through all the dirty details of getting a purchase out of their corporation. It looks a bit different for the other two. This is just an example. And not only the functional interactions, but the timing of those interactions is important. So depending on where you are in terms of initial discussions, a demonstration project, and so on, they have to deal with different parts of that corporation, and understanding when those interactions take place will give you a much better and more positive engagement process with them. I think this is the final slide. So not only is there internal timelines to be aware of when you're trying to engage with projects, But there are external timelines. For example, really obvious, if your solution is in the construction phase, you need to understand that contracts for the construction phase are largely decided about a year earlier when they're making financial investment decisions. So they will, by the time they make a financial investment decision, they will have a project generally understands 80+% of who's going to be delivering what. So if you're going to get a positive decision about being involved in a project at that point, you have to understand that there's a period of, often extended period of engagement to happen before you get to that positive step. So you have to be kind of 3-4 years down the line engaging with projects before they start the construction. So it's just a sort of practical thing to be aware of. The operational phase is a bit more flexible because it goes on for so long, and contracts come and go and are refreshed. But again, if it's a particular area you're interested in, you have to understand when was the last time they issued a contract for, in this case, array cable inspections, and therefore when is it the appropriate time to start talking to them about their next issue of that contract. That's that, more or less in time, I think.
Brilliant. Yes, thank you very much, Graham. So we've got a question come through online and is asking, can you give us an idea of the top 2 or 3 problems you see product developers struggling with when seeking buyers?
I think there's I think it's probably a lack of understanding of some of these things that I began to touch on. So if it's about a supplier trying to sell to a developer or to an owner operator, it's, I think, a common mistake is a common theme when we are dealing with people like with those sorts of innovators and product suppliers, is that it's so obvious to them why their product is better than other products, especially if it's something quite innovative, like a different type of foundation. For instance, that they'll say, "Oh, this will half your installation time." Why aren't people biting my hand off to get this and get it through its sort of demonstration phase? And the reason they're not is because of all sorts of other things that make that decision very difficult at the corporate side. So I think a lack of understanding of the things that a buyer has to deal with and convince their side is one of them. And the other, I think, is similar, which is a kind of over-reliance on the technical side. There's somebody who's developing a product can get so consumed with the technical side and the engineering side of what they do that they fail to really understand or promote the softer, wider side of the benefits or risks that their product might bring into the discussion should somebody choose it. So I think those are two that I see quite commonly: failure to understand the buyer and a failure to enunciate and promote the wider impacts of what they're the wider positive impacts of what they're doing, and I suppose the wider negative impacts is also something that they should be aware of and be ready to address.
Yeah. And maybe just quickly link to that then, how real do you think it is then, the perception of supply chains being closed to new entrants, or is it just maybe not understanding the process and not engaging?
So I think supply chains feel very closed, and I think that in many respects that's not, it's not a false perception, because these are massive projects that rely on global supply chains, and they rely on, and the global supply chains rely on having very well established relationships all the way down the supply chain. So in that sense, it is quite closed, but it's, in my experience, developers, that there are many developers that are extremely keen to find that edge technologically, which would either make them £2 per megawatt hour cheaper, get them through an installation process in one season rather than two. And there's all sorts of things that developers are really keen to promote and engage with. But the global and incredibly deep network of supply chains genuinely really does make that difficult in a practical sense. And that's one of the, it's absolutely one of the barriers that we have to consider quite carefully in the industry, how we allow some of that network to be broken into more easily.
Yeah, great. I think that's a great point to end on. Thank you very much again, Graham, for your time and for your presentation.
Pleasure. Thank you.